Okay friends, so we'll start with the next standard. The standard is AS2, valuation of inventory. Valuation of inventory, what all are we going to cover in this standard? The very first thing that will be covered is the definition, that we are going to see exactly what is covered, what do you mean by inventory, and what all will be covered under the AS2. We will see the scope of the standard, what all is rather when we talk about scope under accounting standard, scope always tells us majorly maximum number of times what is excluded, what all will not be covered. So what under scope what we are going to see is what is not going to be covered. Measurement of inventory, how do we measure the inventory? Cost, what all will be included in cost? NRV, net realizable value, what do you mean by net realizable value, what all will be included under the net realizable value? Okay. There are valuation methods and techniques of valuation that we are going to see. Then we have to talk about joint products, byproducts. Okay. So overall this is what we are going to cover in this standard. These are the basic points what we'll be covering, and we'll talk about as and when the things go on. So we'll move ahead. We'll start with the first part. The thing is definition. Now what do you mean by inventory? Now inventory has a very basic definition, which says that inventory includes anything that is held for sale. Anything that is held for sale. So when I enter into a showroom and if I am purchasing any clothes, the clothes are the inventory held by the showroom person because it is something that is held by them for sale. When I go to a grocery store and if I am purchasing any form of grocery from it, anything, any consumable product that I am purchasing from them, let's say biscuits. So the biscuits that are held by them are basically inventory because they have held it for sale. Now held for sale in ordinary course of activity. Remember, held for sale in ordinary course of activity. Something which is not being held for sale under ordinary course of activity is not considered to be an inventory. That means that if I have a machine in the factory which is used for the production of whatever product that we are making, suppose we are making steel. So for making steel, if steel is something that we sell in the market and ordinarily we are selling it in the market, it is an inventory. But the machine that we have purchased for manufacturing the steel, this machine we are going to sell it in near future when either its life expires or the technology goes obsolete. We don't ordinarily sell such machines. Such machines are not sold ordinarily, hence such machines will not be classified as inventory. I hope the part of held for sale under ordinary course of activity is clear. Okay. Held in the process of being saleable. In the process of being saleable. I basically mean by this to be WIP, work in progress. See, when you talk about big manufacturing companies, let's say we talk about a manufacturing company like Tata which is manufacturing automobiles. So on the year end 31st March, if we see the work that is going on in the factory is not going to restrict itself to work that okay, some cars are to be finished because it is year end. We should not leave half finished stock in the godown because that will lead to a valuation technique that will come to an issue when I talk about in the books of accounts. What Tata mean to say is at the year end they are not going to rush to complete all of their automobiles that are in the process of being manufactured. There will be some vehicles that will be half completed. Let's say 50%, let's say 30%, there will be half completed vehicles in the process. So labor is not going to wait in the factory till these half completed cars have been completed and then we are going to close the accounts. This is not going to happen like this. At the year end, there may be some cars which are only half completed. You cannot sell half completed cars, but you cannot classify them as raw material. Half completed cars cannot be classified to be raw material including steel. So steel to be classified as a raw material under steel, plastic whatever you have, seat belts whatever you have, cloth that you have, textile material, everything to be classified separately. No, these are half completed cars. So these half completed cars are to be shown as inventory. We call them as work in progress because they are in the process of being completed, and once they are completed they can be sold. So we call them also as inventory. Then we have held to be used in process of making saleable product. In process of making saleable product. Now we are talking about the raw material, we are talking about the tools, we are talking about the supplies. So as long as I am talking about the traders, they only hold goods which are to be sold. But when I talk about manufacturers, they have WIP and they have raw material as well. They hold the raw material not to sell them in the market. They don't sell the raw material. Try to understand, raw material purchased by a manufacturer is not sold by them. Tata Automobile doesn't sell the plastic, let's say seat covers, the seats that they purchase, the seat covers that they purchase. They are not selling it in the market. They don't have a market for that. Tata only sells cars. So these seat covers, these let's say those you can call them the base on which the car is being assembled, something that is made of steel. But since Tata actually deals in steel as well, I am not classifying it in that form pattern. Anything, see, when I talk about a car has 400 components, 400 component parts. Okay, so you have a glass in the front of the car, you have plastics, various plastic materials that have been put up in the car. Okay, now there are wipers in the car. Okay, now you have seats in the car, you have back glass, side glasses, mirrors, brakes. There are so many things that are being used in the car, but these are basically raw material. The company doesn't deal in these products. They are being used to make the final product, which we call as a car, which we call it as a car. So these raw materials are held in the process so that the final product can be made and it can be sold. The final product can be sold. So raw material are also classified under the head of inventory when I talk about accounting standard 2. Okay, so we talk about finished goods, we talk about WIP, we talk about raw material. Then there are two more terms that have been used, which are tools and supplies. Okay, tools and supplies. Sir, what do you mean by tools? What do you mean by supplies? See, when we are in the manufacturing process, we also require some other materials. Let's say for heating process, I will be needing coal. So my factory basically runs on a thermal project on which we need coal. So coal can be said to be supplies which are also being used, which are purchased and also being used to make this final product. Okay, so these coal will also be considered to be raw material in the definition of accounting standard 2. Okay, sir, what do you mean by tools? See, let me give you another example. Suppose the class in which you are sitting, the classroom in which you are sitting, you can see various types of assets in the class. Let's say there are desks, let's say there are benches. Okay, we also see a projector over there. Okay, we also see an air conditioner over there, we see fans over there, and there are various types of such assets that you can see in and around you. Now when I talk about these desk, benches, projectors, AC, fan, if anything goes wrong, like suppose in the seat that you are sitting, it is moving because one of the nuts has gone loose. So the classroom people, these classroom people also keep certain tools with them. You call them screwdrivers, and various such tools are held by them. First thing, tell me, for a classroom, what are the desks, benches, projectors, AC, fan called? Should I call them as my tangible assets classified under property, plant and equipment, or are they inventory? So sir, they are basically property, plant and equipment, correct? Okay. Now my question is, the person from whom these classroom people have purchased all these things. We have purchased the desk, we have purchased the benches, we have purchased this AC. From the people from whom we have purchased this product, for them, from the person from whom you have purchased, for them it will be classified as inventory. For them it will be AS2. Okay. So now the screwdriver that is held by the company, which is to be used in this desk, in the benches, in the projectors and AC, held by the classroom, cannot be classified as inventory, but these tools are also held by the people from whom we have purchased this material. For them, these tools will be classified as inventory because they are held to be used for inventory itself, So you can call loose tools to be inventory. Okay. Sir, you also told us that these are being held by these classroom people and they will not be classified as inventory for them. Generally, we classify them under AS10, property, plant and equipment. Okay, so I am not going to discuss much about this part, the tools specific to any fixed asset. We are not going to talk about tools specific to any fixed asset. We are just talking about the tools specific to inventory. Sir, why not right now? It's going to create a confusion. See, when we'll talk about accounting standard 10, what are property, plant and equipment? We need to discuss loose tools over there. Okay, so right now we are not clear with the definition of fixed asset. We are not going to talk about the tools over here. The tools will be considered if they are specific to inventory. We are going to classify them under inventory. Okay, so what the definition says? Definition says that anything that is held for trading, anything that is in the process of being used, in the process of being saleable and held for use in the final saleable product. So raw material, WIP, finished goods are considered to be inventory. Okay, so that is what the definition says. So with definition we are clear that any finished goods held by the company in the ordinary course of business, WIPs and raw materials will be considered to be inventory. If something is not held in the ordinary course of business, it will not be classified as inventory. So we'll open our book, we'll see what do you mean by inventory. Held for sale in the ordinary course of business, in the process, form of material or supplies to be consumed. So company deals in purchase and sale of car. If the company deals in purchase and sale of car, it will be classified as inventory. Company has furniture in the showroom which replace every 4 years. You have furniture in the showroom which we are going to replace in every 4 years. Is this ordinarily saleable? This is not ordinarily saleable. This will not be classified as inventory. Next one, company manufactures car and during the year 50 cars remain unfinished. 50 cars remain unfinished. Do we classify them as inventory? Yes, they are WIP. Company manufactures car and has steel, tire, headlamps kept in stock. Raw material in the C point, we classify them as inventory. Company has coal in stock which is used for melting steel. Again, supplies which are used is classified as inventory. Okay. Spares not specific to any particular fixed asset, classified under inventory, as we have talked about. The second, third and fourth part, fourth and insurance and standby equipment we are going to classify, we are going to consider, we are going to look back into the definition when we will be studying AS10. So right now we will move ahead and talk about the scope. What shall not be covered under AS2? First is construction contracts are not covered under AS2. Sir, construction contracts. Construction contracts you have studied in CIPCC under costing as well. There are two types of people. There is a contractor and there is a contractee. The contractee is basically the builder who has given work to the contractor to complete the building. The contractor is working on behalf of contractee. So for contractor we have AS7, but for contractee we don't have any specific standard. And construction contracts are not covered under AS2. Okay. So sir, the builder for whom the contractor is working, and then we had studied something as work certified, work not certified. There is some work that has been certified and the builder has paid the amount to the contractee related to the same. So the builder has paid the amount, he has made an entry, contractor account debit to bank, contractor account debit to bank. Sir, where will this amount contractor account debit, because contractor has raised the bill and we have paid the amount, where will that amount of half finished building, half finished building reflect in our books of accounts? Where are we going to reflect it in our books of accounts? If AS2 is not applicable, how are we going to account for the same? Are those property, plant and equipment for the builder? So first thing is, builder only builds a flat to be sold under the ordinary course of activity. Ordinary course of activity. So for builder, flats are inventory. But as long as they are being constructed, they are not covered under AS2. But once, mind my words, it is completed, once the building is completed, it is covered under AS2. So we are going to account for finished buildings for builder under inventory, but unfinished buildings are not going to be covered under AS2. So how is he going to value the same? He is going to show them as advance to contractor or as WIP, work certified not certified, in his books under asset side. That's how the accounting is done as long as the building is not completed. Once the building is completed, AS2 will be applicable. This complete amount will be transferred to building account debit to advance from to contractor, and then we are going to value it as per AS2. Next one is service provider. Service providers like you, my friend, are going to be chartered accountants, future chartered accountants. You are going to provide service to your clients. So the one who provides service to the clients, the service providers, these service providers are not covered under AS2. Their inventory is not covered under AS2. Sir, how does a service provider has an inventory? See, when I talk about audit, the audit service is something that is supposed to be completed on or before 30th September, last date of finalization of audits. But for big giant companies, we conduct audit on monthly basis. So up to 31st March, let's say 60 to 70% of the audit work has been completed. So up to year end, 60 to 70% of the audit work has been completed, but revenue by the auditor cannot be recognized because the audit is, unless the audit is completed in all terms, revenue cannot be recognized by service provider. We have studied this in AS9. In AS9 says that when the service is completed, revenue can be recognized. So half of the service has been provided by the auditors. This half provided service cannot be classified as inventory under AS2. AS2 does not cover service providers, but if service provider has various other forms of tangible assets with him, like he has files, he has pens, pencils, etc., and other such small items in his stationery, I can call them as stationery, which is one of the very big assets held by the auditor. So these stationeries are covered under AS2, but service providers provided service, half completed service, is not covered over here. Let's move ahead. Financial instruments. So financial instruments, my friend, financial instruments for any person, like if you are purchasing certain financial instruments like shares and debentures, for you it will be classified as investments, and we have a specific standard available, AS13, AS13 available, under which we are going to account for the same. Okay, but inventory, so for whom is financial instruments and inventory? We are talking about the brokers and traders in the market, whose primary business is to purchase and sell such shares and debentures. For them, financial instruments are not covered under AS2. They use the valuation concept as per AS13. So they have been told to use the valuation concept as per AS13, though for them these shares and debentures are not investments, they are inventory, but they have to use the valuation concept as per AS13 as the guidance that has been provided. Financial instruments are not covered under AS2. Now there are agricultural produce, forest products, livestock, again which are not considered to be inventory. Sir, what do you mean by them? Forest products, when I talk about farmers who are engaged in various farming activities, like if you are in the primary business, you are doing the primary business of growing wheat or rice. So for you, such wheat and rice till the point of harvest, mind my words, till the point of harvest is not covered under AS2. But once harvested, we are going to use the valuation techniques as per AS2. Okay. Forest again, if you have teak farms, till the time the forest, these teak trees are being grown, AS2 is not applicable to you. But once you have cut it down into small lumber pieces, AS2 will be applicable to you. Okay. Livestock, we are talking about animals. Okay. So you have cows, you have buffaloes. Let's talk about a pet shop. The pet shop has various such livestocks with them. AS2 is not applicable to them. AS2 is not applicable to them. Generally, the valuation technique they use is fair value. Fair value. Okay. So when I talk about livestock, and livestock means animals, but what about produce from such animals? The produce from the animals is covered, animals are not covered. So if I have sheeps as stock, sheeps are not valued under AS2, but the wool we get from the sheeps are valued under AS2. Okay, we have these cows in stock, cows are not valued under AS2, but the milk produced by the cows is valued under AS2. Okay, I hope this is clear where we have to use the fair valuation techniques. Okay, so we'll come down over here. Work in progress under construction contracts, as we discussed right now. Work in progress in case of a service provider, financial instruments, all these are excluded from the scope of AS2. Then there is producers inventory of livestock, as we talked about, agriculture and forest products. Okay, there are some more: mineral oils, ores and gases. Mineral oil, ore and gases. Now what about mineral oil, ore and gases? If you have these oil fields with you, if you have these mineral reserves with you, okay, so now if I am the owner of a mine, any mineral mine, I am not going to value my stock as per AS2. We have a guidance note available for the same. But if I am suppose a manufacturer who purchases such mines, doesn't purchase the mine but the products that are available from the mine, let's say coal mine, we are purchasing coal. Okay, so iron ore mine, we are purchasing the iron ore from them. Such coal, such iron ore purchased by these manufacturers are valued under AS2. They are valued under AS2. But the owners of these mines, owners of these oil fields don't use AS2 as the valuation technique. How are they going to value them? They are going to measure it at NRV. Okay, net realizable value. Okay. So as we are going along, I'll talk about Indian accounting standard as well. Comparatives are applicable to you. So when I talk about the scope of accounting standard, how does the scope differentiate under Indian accounting standard compared to accounting standard? Indian accounting standard compared to accounting standard, where does the scope makes a difference? Biological assets under Ind AS 2 is excluded. Biological assets under Ind AS 2 is excluded. We are not excluding livestock. In my words, we are not excluding livestock. We are only excluding those biological assets which are valued under Ind AS 41. Sir, what is Ind AS 41? There is a standard that has been included under Indian accounting standard which is related to agriculture. So any biological asset which we are using only for agricultural purpose, like we are using buffaloes and cows for agricultural purpose, we are using bulls, let's say, for agricultural purpose, for any animal that is being used for agricultural purpose, then we are not going to value such animals under Indian accounting standard 2. For them we have a specific standard, Ind AS 41. Clear? Okay. That means other than those which are not covered under agricultural purpose, like pet shop, they have dogs, they have fishes, they have cats, they have parrots, they have various animals which are available to be sold to the local people in and around the city, in and around the town. These people will do the valuation as per Indian accounting standard 2. Please my friend, don't get confused. I am talking about Indian accounting standard right now. Indian accounting standard, this is a differentiating factor. When I talk about accounting standard, livestock is eliminated. When I talk about Indian accounting standard, only those livestock which are used for agriculture are eliminated. Only those livestock which are used for agriculture are eliminated. So this is the first point of difference when I talk about Indian accounting standard. Second point of difference is we don't see service providers excluded over here. We don't see service providers excluded over here. That means service provider has to value his inventory as per Indian Accounting Standard 2. Service provider, chartered accountants, architects, doctors are going to make any half provided service by them to be valued as inventory as per Indian Accounting Standard 2. Difference, AS2, service providers are excluded. In AS2, service providers are not excluded. I hope it is clear. Then we have this last point, commodity brokers and traders. Commodity brokers and traders. Now we are talking about commodity brokers. Now let's see the difference. When I talk about over here, shares, debentures and financial instruments, we haven't seen commodity instruments over here. That means those brokers who are dealing in commodity instruments, like if we are dealing in commodities like copper in trading, okay, we are dealing in commodities like gold in trading. Are we excluded from accounting standard 2? Accounting standard? No, we are not excluded. But Indian accounting standard excludes us. Indian accounting standard excludes us. Commodity traders are also excluded from Indian accounting standard when I make the valuation as per Ind AS 2. Provided they value their inventory at fair value. They have to value the inventory at fair value. Sir, what if they are not valuing the inventory at fair value? If you are not valuing your inventory at fair value, then you will have to apply Ind AS 2. You will have to apply Ind AS 2. So, there are certain exceptions and there are some valuation techniques that are being given under Indian Accounting Standard. Indian Accounting Standard excludes biological assets held for agriculture. Other biological assets are not excluded. Commodity brokers are excluded from Indian Accounting Standard provided they make the inventory valuation at fair value. If they are not valuing it at fair value, they are not excluded from Indian Accounting Standard 2. Okay. Okay. So we'll move ahead. We'll look at certain answers as per accounting standard. If required, I'll ask you to answer them as Indian Accounting Standard as well. Which of the following are accounted as per under AS2? So when I talk about cows, livestock excluded. Gold, mineral reserves, we have seen mine, minerals and ores excluded. WIP construction excluded. Maturing wine, these are WIP. Some people will say, sir, we have seen there are 2-year-old wine, 3-year-old wine. So for 2 years, 3 years, they are maturing inside a drum and kept just to mature and make a wine which is such old, 2-year-old, 3-year-old, we'll see 15 years old, 20 years old wine. So sir, holding an inventory for so long, are we going to classify it under AS2? My friend, in the definition that we have seen, we have never seen anywhere written something which is to be completed within 12 months. Is it written anywhere that you have to complete it within 12 months? It is not written. That means maturing wine, whatever thing that takes hell lot of period, doesn't make any difference, will be covered under AS2. Only thing that are excluded we have seen, construction contracts are excluded. Okay, service providers are excluded, financial instruments are excluded, livestock is excluded, forest products are excluded, agricultural products are excluded, mine minerals are excluded. So nothing else is going to be in the exclusion list. Clothing included, lumber of wood distributor, lumber, the cutted down pieces of wood included. I told you that in the forest, as long as the trees are standing, AS2 is not applicable. Once you cut them down, AS2 will be applicable. Okay, so we'll move ahead. Amit rents some of its equipment. Will they be classified as inventory? Now it depends whether it will be classified as inventory or not. Firstly, Amit, let's say he has a car. He doesn't use the car much, so he has given the car on rent to these Ola or Uber drivers. Okay, so he doesn't use the car much. This is not his business. He is a CA, so he is into practice, but he doesn't use the car much, so he has given his car on rent to Ola or Uber drivers. So is the car held to be ordinarily sold? Is the car held to be ordinarily sold? No, the car is not held to be sold ordinarily, which means that this is not going to be classified as inventory. This is not going to be classified as inventory. I hope it is clear. So renting of any asset is not classified as inventory. Sir, where are we going to classify them? Is this a property, plant and equipment? Is this an investment? So most of them, or you are going to say it is a property, plant and equipment, but it can be an investment. It can be an investment. Again, something that I am leaving in doubt scenario in front of you, because when we will study AS10 and then we will study AS13, I will discuss this question again with you. Okay, so AS10 we are going to see the answer of this second part. The first question that has been asked over here, whether Amit rents an equipment, it is to be classified as inventory or not, we have answered it. This is not to be classified as inventory. Okay. Sir, what if Amit's business was to give these machines on rent? Amit has a business, he has various machines which he provides on rent to the people, then can be classified as inventory? My friend, my question is the same. Are you going to sell these machines ordinarily or you are going to rent them ordinarily? Sir, we are going to rent them ordinarily. We are not going to sell them ordinarily. Since you are not going to sell them ordinarily, we will consider them to be not inventory, but definitely can be property, plant and equipment or investments. We will discuss that part later, but this is not an inventory. We will move ahead. Night Limited sells beer to the customers. Some of the customers consume the beer in the bar run by Night Limited. While leaving the bar, consumers leave empty bottles in the bar and the company takes the possession of the empty bottles. The company has laid down a detailed internal record procedure for accounting for these empty bottles, which are sold by the company by calling tender. Okay, so we are talking about bars. There are bars have various bottles with them. Okay, people generally consume the beer, whiskey, wine in the bar and then they leave the empty bottles on the backside. Now there are so many bottles that are accumulated every day that company actually has made, the question says that company has actually made an internal record of these bottles. Okay, tell me my friend, can the bar who are selling these wine, whiskey, beer, let's say of Bacardi brand, they go to the Bacardi company and they tell us we have the bottle with us, just refill the wine, whiskey or beer in it. Is the company going to accept it? The company is not going to accept it. They will tell you we haven't given these bottles at a price to you. They are given free along with the bar, along with these beers, whiskey and wine that we are selling it to you. Okay, so these bottles are given free to you. It is not our headache. We don't want it back. So now the company has an internal record. What is company going to do with this? The question says that company are going to sell these bottles. So there are various people, various buyers, scrap dealers who are going to buy these bottles from the company. They are ready to buy. They come, they take all these bottles, they pay the company and they go away. So what do you call these empty bottles as? Can we classify them as inventory? Are they the asset to the company? Now when I look at the conceptual framework, the basic definition of asset, anything that gives an economic benefit in future is asset. Anything that gives an economic benefit, monetary benefit in future is an asset. These bottles are giving us money in future, definitely an asset. Okay, definitely an asset. My second question is, are they inventory? Can we classify them as inventory? Anything that is ordinarily saleable is inventory. Anything that is ordinarily saleable is inventory. These bottles, companies sell them ordinarily or not ordinarily? Some of you will say yes, ordinarily. Some of you will say no sir, not ordinarily. We have the bottle, that's why we are selling them. If we don't have the bottles, this is a regular process that people are leaving the bottles on the backside and then the company is maintaining internal record and selling it. That means we can say that these bottles are being ordinarily sold by the company. And if the company is ordinarily selling them, so well within the definition of accounting standard, we can classify them as such assets as inventory. So the first question is this an asset? Yes, because it gives a future economic benefit. Second is this an inventory? Because it can be ordinarily sold, it is to be classified as inventory. Third question is how to value. So we haven't seen the valuation technique till now, but as per what you have studied in CA Inter, generally the valuation measurement is cost or NRV, whichever is lower. So cost for the bottles is 0. NRV is whatever you will fetch by selling it. So let's say if you are fetching 10,000 rupees by selling them, so 10,000 rupees. So whichever is lower, 0. So we are going to show them at, you're not allowed to show an asset at 0, but definitely an asset is to be shown. We show them at the minimum value accepted in the balance sheet. So if 1 rupee is the minimum value at which the balance sheet is shown, 1 rupee will be classified as inventory. Decide whether empty bottle is the asset of the company. Yes, as we classified. If so, stock existing on the balance sheet is to be valued as per AS2 or not? Yes, we are going to value. So remember, when I answer this question, scrap is also classified as inventory because it is ordinarily sold by the company. Ordinarily sold by the company. So in the chart that we had made, definition, this part includes finished goods and scrap. Finished goods and scrap. Okay. Okay, there are some issues. Under the held for sale that we have classified, we are going to classify them these as finished goods and scrap. This includes finished good, this also includes scrap. I hope it is clear. So we can move ahead. Okay. Okay, now we can see it on the screen. Okay, there are certain technical issues, sometimes certain things that cannot be helped. We'll move ahead. So we'll look at the next question. We look at 2.4. Can material issued on loan be classified along with inventory under the head loans and advances? First, try to interpret the question, understand and interpret the question. Suppose I am a gold merchant and I need 1 crore rupees. I go to bank, I tell them please provide me with 1 crore rupees. The bank says we don't trust you. What if we give you 1 crore rupees and you ran away, so what are we going to do? Okay, so bank says, what the gold merchant says is, what you can do is you can hypothecate the inventory that we have. You can hypothecate the inventory that we have. That means whatever inventory that we are holding in the form of gold will be hypothecated. Whatever money that we get, we will pay it to you. Bank again says, no, we don't trust you. You will sell the inventory and if you ran away, then what we will do? Okay, then keep this as security. Keep this as security. Bank is keeping the gold in their locker as security. Muthoot Finance, okay, you go over there, you give your gold to them, they are going to provide you with the loan against such gold. So the gold is kept in their treasury. It is not held with you, it is held in their treasury. So you have given your inventory on loan. You have given your inventory on loan to Muthoot Finance and they are going to provide you with the loan against them in cash. You have given them inventory as security. I can call it as a loan as well, security, and they have given me the loan in monetary terms. The entry that I passed of the complete transaction is bank account debit to loans, and I should call this as secured loans. Bank account debit to secured loans, correct? So whatever amount, 1 crore rupees, so 1 crore rupees. But the inventory that I have given them as security has not been accounted for. The inventory that is given as security has not been accounted for in the books of the merchant. That means this inventory is still reflecting in the books of the merchant for 1 crore rupees. Whatever inventory is holding, the 1 crore rupees is also included in that inventory, correct? So whenever we give something as security to the other person, we don't de-recognize such asset from our books. We don't de-recognize such asset from our books, correct? Okay. Should this be classified under AS2 is what the question is saying. Should this be classified as AS2? My friend, anything that is ordinarily saleable is classified under AS2. Is this ordinarily saleable? Can you sell it ordinarily? You cannot sell it ordinarily. Since you cannot sell it ordinarily, this will not be classified as inventory. We are not going to classify this as inventory. I hope it is clear. So suppose you have total 5 crore rupees as inventory. 4 crore will be classified under AS2. 4 crore will be classified as AS2 and 1 crore, where are we going to reflect it? Under loans and advances on the asset side. Inventory held as security by the other person, not to be classified as inventory. I hope it is clear. Okay. We'll look at the next question. Sun Limited fabricated special equipment. So you are a special equipment manufacturer. As per the requirement of the other person, you manufacture the machines as per the drawing and design supplied by the customer. However, due to liquidity crunch, the customer has requested the company for postponement in delivery schedule and requested the company to withhold the delivery of finished goods and discontinue the production of balance items. Due to liquidity crunch, the customer that you are having has faced certain liquidity issues. So he has asked you postponement of delivery. He has told you that I don't need the further inventory right now, let's postpone it. The day I'll be in a situation to buy it further, I am going to buy the same from you. As a result of detailed customer balance and goods held by the company as work in progress are given to you. WIP is worth 85 lakh that you have in your books. Finished, there were certain panels that were finished, but because he ordered, because he said that I am not going to take the delivery right now, it is held with you 55 lakhs. Debtor, you have to collect some money for already delivered solar panels worth 65 lakh. Now the petition for winding up with the customer has been filed. Now the customer to whom you have sold has actually filed a petition. He is not going to pay you anymore. And these are special equipments, specially designed for the customer, cannot be sold to any other person. So now you have specialized equipment which are full completed worth 55 lakh, half completed worth 85 lakh, and 65 lakh rupees worth of inventory is already been given, which you are not going to get as a return. You cannot ask as a return because the person has filed a winding up petition. Now the question is, how are you going to value all this? Now as per AS2, cost or NRV, whichever is lower, since nothing is going to be received against this finished goods and WIP, this should be valued at 0. Now nothing as per, now if I talk about AS1, prudence, concept of prudence, anticipated losses, this 65 lakh should also be valued at 0. Many of you are going to say, sir, these finished goods, these WIP are going to definitely have some scrap value. So we should value it at scrap value. Why to write down the complete thing to 0? Okay, so you can write the answer over there, scrap value. Specialized equipment, nothing was given in the question. That's why I told you that better write 0. Nothing else, the answer won't make a difference as long as the concept that has been explained by you is correct. Okay. So we'll move ahead. Wholesale trader of grains. Wholesale trader of grains. You are a wholesale trader. Claims that he can value his inventory at fair value as AS does not apply to him. AS2 does not apply to him. No, he will have to value its product at cost or NRV, whichever is lower. AS2 is definitely applicable to him. AS2 is definitely applicable to him. Once the inventory is harvested, once the agricultural products are harvested, AS2 becomes applicable from there and then. So definitely the wholesale trader will also have to follow AS2. He cannot say that it is not applicable to him. We look at the next question. The main object of the company is to undertake plantation activities. Main objective is to take up plantation activities, rising of teak, and the line is missing. Just listen to what I am saying to you, what I am telling you. Other forestry operations. So what is your business? Plantation of teak. It takes 10 to 12 years for the teak to grow. It takes around 10 to 12 years. In order to carry out the plantation activity till full growth of the tree, is ready, company will be incurring various expenditures. Okay, it takes 10 to 12 years for the teak to grow up, and company will definitely have to expense a lot for maintaining such trees till that time. Company has decided to treat all these costs as planting, subsequent maintenance, lease rent, etc. as capital expenditure, and treat as long-term capital receipt, sale proceeds when they finally end at 10 to 12 years. Comment on the appropriateness of the statement. First thing, is this a capital expenditure? No, my friend, this is not a capital expenditure. I can say that my operating cycle is 10 to 12 years because the product that we ordinarily deal with, teak, it takes 10 to 12 years to get ready. Is this covered under AS2? Till the time the teak is growing, it is not covered under AS2. Once you cut them down, it will be covered under AS2. We will be classifying it under AS2 once they have been cut it down. So AS2 doesn't become applicable over here. Okay. Okay. So we are done with the definition, we are done with the scope. We'll talk about the measurement techniques. So how are we going to measure the inventory? It is very simple. We measure it at cost or NRV, whichever is lower. Cost or net realizable value, whichever is lower. Mind my words, the word is net realizable value. I haven't used the word selling price. Okay. I haven't used the word selling price, it will not be selling price, it will be net realizable value. Now we need to understand what is cost and what is NRV. So we'll move toward the next step. What is cost? So if you are a dealer, you are a trader, for you cost will be purchase price, correct, at whatever price we are purchasing. So if we are purchasing a car, whatever we are paid to the company, let's say we are purchasing a Maruti car, whatever the dealer pays to the Maruti company. If you are a trader, okay, you are trading in, let's say, wood, so whatever you have paid to the teak farm owner, so the amount that you pay to them is considered to be the purchase price. Now it's not just paying the purchase price to them that you get the inventory, you have to get the inventory from their factory to your showroom or your warehouse, so you incur transportation cost. So transportation cost is also included. Sometimes the route via which all these products are going to come are so bad that there can be a major loss that can happen. So now if you are buying a car and car is coming on all the way from some other state, say you have to get the car in Chennai and it is being manufactured somewhere in Gujarat, let's say Surat. So getting it from Surat to Chennai, if suppose the routes are very bad and while coming in the truck, suppose one of the glass breaks down, so it is a very huge loss for the company. Generally, company takes up a transit insurance in such case. So transit insurance cost can also be included in the valuation of inventory. Okay. We have talked about gold merchants. Now suppose there is a gold merchant, there is a jewelry showroom, the jewelry showroom person gets purchases gold in tons, suppose he is purchasing it in tons. Okay, there is a very major festival that is going to come up and people are going to buy gold in bulk, so they are buying in tons gold which is supposed to come all the way again from, let's say, Surat. Let's say Surat, the gold is going to come all the way to Chennai. Now on the way you need also, it's not just the transportation that we incur, not just the transit insurance, but we also need the security, because it is a very valuable thing that is coming all the way traveling to Chennai. My friend, such a huge cost that you are going to incur, towards the transportation, you are also going to look at the safety and you are going to incur some security cost, correct? So these security costs can be called as administration cost. I can call this as administration cost. I can include such administration cost as well. It is till the point of receipt of goods. So administration cost can be included till the point of receipt of goods. Any administrative cost till the point of receipt of goods can be included in the cost of inventory. Okay, I hope it is clear till this point. What all are we going to include? Sir, anything that we are going to exclude? Yes, trade discount. We are going to deduct trade discount, but we are not going to deduct cash discount. Not cash discount. Sir, what is the difference? Now suppose I go to a company, let's say Apple. Now Apple says that one of my phone I am going to give you for 50,000 rupees, you can sell it for 70,000 rupees. I tell them that I am going to sell 100 phones throughout the year. I am going to buy 100 phones right now immediately from you. Give me some discount. 50,000 rupees is a high price, give me some discount. The Apple company accepts, okay, we are going to give you one phone for 48,000 rupees. So this discount that has been given is a volume discount, we call it as a trade discount, which is available for everyone. Let's say it is available for everyone. So if you purchase at above a particular level, company is going to give you some discount, we call it as a trade discount. But if the company says that okay, you are taking 100 phones for 50,000, if you pay us within 30 days, if you pay us the amount within 30 days, we are allowing you to take the phone on credit, but if you pay us within 30 days, you will have to pay 48,000, we will give you a 2,000 rupees ka discount. The 2,000 rupee discount is something that we call as cash discount. This 2,000 rupees is considered to be cash discount. I hope it is clear. What do I mean by cash discount? So cash discounts are not deducted. They are financial in nature. The company has to take the decision in future. Company has time to take the decision. But if something that is to be taken immediately, Company is providing you with 2-3 offers and you are taking the offer, you are picking up one of the offers immediately. These are known as trade discount. Trade discounts are supposed to be deducted, not included in the cost of the inventory. Cash discounts are not to be deducted. We deduct rebates and we deduct duty drawbacks as well. Now when I talk about rebates, rebates is like again a volume discount, kind of volume discount, but which is received later. Now suppose for a television dealer, let's say you are a Sony dealer. Sony company tells you that if you sell 1000 TV per year, and if suppose company had sold you one TV for 20,000 rupees, company says that we'll reimburse 500 rupees per TV. We'll reimburse 500 per TV provided you sell more than 1000 TVs. So during the year, up to the time I have sold 800 TVs, 900 TVs, up to 999 TVs, company, what I have paid to the company is 20,000 into 999. But as soon as I sell that one TV extra 1000 TV, at this point what I have to pay to the company is one TV into 20,000, but company will reimburse me 500 rupees for all 1000 TVs, for all 1000 TVs. This reimbursement is what I am going to receive back. These reimbursements are known as rebates. Rebates are again to be discounted. They are as good as trade discounts. That's why they are deducted, but we don't know. Initially the company doesn't know whether they'll be able to achieve the target or not. That's why rebates are deducted later. Suppose, sir, that we get the rebate in the next financial year. Now company has given us an offer that January to December, if you are going to sell 1000 TVs, we'll give you a rebate of 500 rupees. Up to March, we had sold 300 TV. So we have paid the company 300 into 20,000 and we have shown this as our inventory. Next financial year, April to up to October, we have sold the remaining 700 TVs and we have got the rebate of complete 1000 TVs of 500 up to 500 rupees. Will I have to restate my preceding financial year statement as well? No. Rebate will be deducted in next financial year only. We are going to deduct it in next financial year only. So if it is Jan 2017 up to March 2017, 300 TVs into 20,000, we will show this as purchases. Next financial year, we are going to deduct this discount. Okay. Okay. Then there are duty drawbacks. Generally in case of export, if you have exported a particular product out of India or suppose to a special economic zone, then you get the duty back from the government. So we don't include duty under the valuation of inventory. Okay, so these are the exclusions and inclusions that we talk about in case of just a dealer and trader. I am yet to come on manufacturer. Sir, what about manufacturer then? Manufacturer will incur those costs as well. He has to incur the purchase price, he has to incur transportation cost, admin up to the point of location to getting the product up to the present location. Okay, transit insurance, everything is going to incur. He is going to incur some additional cost. He will include material cost as we have discussed already. He will include labor cost as well. He will include some factory overheads as well. Now these factory overheads are of two types. We call them as fixed, we call them as variable. We don't include any other cost as per AS2 into inventory. We don't include administration cost. We don't include selling and distribution cost. They are under exclusions. We don't include interest. If you want to include the interest under inventory, we are going to value it as per AS16, nothing to do with AS2. Borrowing cost, AS16. We are not going to discuss it over here. Interest is not included as per AS2. Okay. Only factory overheads are included. We don't include administration cost. We don't include selling and distribution cost. Remember my friend, any administration cost, earlier we have discussed administration cost, to the getting it to the present location can be included, not more than that. Okay. So now suppose we incur two type of rental cost. One is for the factory and the other is for the office. So factory, the rental of factory is of the nature of factory overhead. This is going to be included. But office is of the nature of administrative overhead. This is not to be included. Sir, why this difference? Because factory overhead, without incurring the factory rent, we cannot manufacture the product. We need a factory to manufacture the product, so this cost is going to be included in inventory. But office is purely for sale purpose, purely the place at which the accounting and other aspects can take place. Even if the product is not sold, this expense is something that you are going to incur. So it helps nowhere in manufacturing of the product. That's why you don't include it under administrative under the inventory cost. Okay. So now we'll talk about fixed and variable overhead. First I'll talk about fixed factory overhead. What my AS2 has to talk about in case of fixed factory overheads. Normal cost per unit shall be included. Sir, what do you mean by normal cost per unit being included? Suppose I pay a factory rent of 1 lakh rupees per month. Now whatever product I manufacture, whatsoever quantity I manufacture it or not, I'll have to pay this 1 lakh rupees. I cannot reduce this. Can be increased in future for some other reason, let's say rental clause, but it cannot be increased or reduced. Suppose the factory has a capacity to manufacture 1 lakh units. So we should actually manufacture 1 lakh units. But suppose the market demand is not so high, market demand is 80,000 units. So these 80,000 units, the market demand considered to be the normal capacity, is for which we allocate the fixed factory overhead to on per unit basis. Sir, why so? Why not why not 1 lakh unit? Because we are never going to manufacture 1 lakh units. Suppose we are going to manufacture 80,000 units, so 1 lakh rupees, if I divide it by 1 lakh units, and I am going to manufacture 80,000 units, so only 80,000 rupees will be allocated. And what about the remaining 20,000? I have expended from my pocket, but I am not allocating it anywhere. So this will be a wrong thing that will happen. That's why we are going to use normal capacity, because normally that is the demand that we are supposed to satisfy. So 1 lakh rupees will be divided by 80,000 units. 1 lakh rupees will be divided by 80,000 units, 1.25 per unit. 1.25 per unit is the cost that we are going to allocate. So in the year end, suppose I have 20,000 units in my stock. So what the overhead that I am going to allocate to the stock is 20,000 into 1.25, 25,000 rupees. 25,000 rupees. So factory overhead is always allocated on the basis of normal capacity. I hope it is clear. Suppose we actually manufacture only 60,000 units. We have actually manufactured only 60,000 units. So don't you think that 1 lakh rupees should actually be divided by 60,000 units? But think, as an auditor, I have a doubt. When the market demand was 80,000 units, why has the company manufactured only 60,000 units? 20,000 units were not manufactured because of various reasons. One of the reason, any reason I talk about, one of the reason could be machinery failure. One of the reason could be labor strike. All such reasons are considered to be abnormal in nature. Because if the market demand is 80,000, you are supposed to manufacture 80,000 units. And if you have not manufactured 80,000 units, still inventory shall be valued as per the normal capacity. Again, irrespective of the fact that we have made 60,000 units, I will divide 1 lakh units by 80,000 only, and if my inventory is the same 20,000 units, I will multiply it by 20,000 and 25,000 rupees will be allocated to inventory cost. My concern is valuation of inventory. I am not concerned about the remaining amount. What is going to happen about the remaining amount? That concept you have covered in costing. So 1 lakh divided by 80,000. We have three parts. 20,000 we have as stock. You have actually manufactured 60,000, 20,000 is in stock. That means 40,000 units are sold. So both of them together makes it 60,000, but we have divided it by 80,000. Remaining 20,000 is considered to be abnormal loss. So if I multiply each of them per unit by the following cost, this is included in inventory. This is costing aspect, nothing to do with AS2. This will be part of expense and 20,000 will be transferred to P&L as loss. Okay. So I am not concerned about these two parts. I am only concerned about this part. Some students will have a doubt that suppose, sir, actual manufacturing was 90,000 units. Above market demand, we have manufactured more in anticipation that maybe we can sell more in future. So are we still going to divide 1 lakh rupees by 80,000? There will be a flaw now in dividing it by 80,000, because if I divide it by 80,000 and suppose complete 90,000 units are in inventory, suppose we can assume it, complete 90,000 is in inventory, what will happen is the cost that is allocated to inventory is more than the cost that is incurred, 1,12,500. And you will say, yes sir, this is abnormal gain, we have studied it in costing, but AS2 does not allow such abnormal gains to be accounted for. We are not going to account for any abnormal gain under AS2. So AS2 says no, in case you have manufactured more than the normal capacity divided by actual capacity, divided by actual production, that means now 1 lakh rupees will be divided by 90,000 units and multiplied by 90,000 units. That means 1 lakh rupees will only be attributed to inventory. Suppose 90,000 complete is in inventory, that was the assumption. If you have only 20,000 multiplied by 20,000, how does it matter? But the per unit cost will now be divided by 90,000. Sir, we are confused. Sometimes you are saying normal capacity, sometimes you are saying actual capacity. See, what you have to do is fixed factory overhead has to be divided by normal capacity or actual capacity, whichever is higher. Remember, whichever is higher. Fixed factory overhead, like earlier 1 lakh normal capacity was 80,000, actual production has been 60,000. We are dividing it by normal capacity 80,000 or actual capacity 60,000, whichever is higher, 80,000. Now we have manufactured 90,000 units, normal capacity 80,000, actual capacity 90,000, whichever is higher, we are dividing it by 90,000. Sir, what if it was manufactured above practical capacity, above 1 lakh? So not possible. Practical capacity is something maximum that the machine can manufacture. But still, if you have manufactured 1,10,000, if I have to write it as a theory in the book, doesn't matter. Actual capacity 110, normal capacity 80, whichever is higher 110, I will divide it by 1,10,000 units. So it doesn't matter. I hope this is clear. Regarding material, regarding labor, regarding variable factory overheads, whatever cost that we have incurred is generally what is included, but don't include abnormal loss. So what can be the abnormal loss in this case? There can be various abnormal losses, like if the input in a machine is 1 lakh units and the machine is supposed to give 95% production with 5% ka wastage, 5% wastage, 95% production. So 95,000 should be the normal output. I am not saying that this is the actual output, normal output with 5,000 as scrap or maybe lost in the air, can be anything. Now suppose actual production has been 94,000. Actual production has been 94,000. So 1,000 units extra loss is considered to be abnormal loss. That means whatever cost that I have to allocate will be allocated to 95,000 units for inventory valuation instead of 94,000. Suppose, let's talk about transportation. We purchase some inventory. Now we have purchased 1 lakh units, but by the time it reaches the factory, some units are destroyed in the process of transportation and we actually receive only 80,000 units. So 80,000 units are considered to be the normal receipt. But now actually what you received actual receipt has been 75,000 units. So remaining is considered to be abnormal loss. Per unit cost allocation will be on the basis of 80,000. So the concept is the same as we studied in fixed factory overhead. Concept will remain the same. Abnormal losses are not to be included as a part of inventory. Okay. There are various other exclusions as well. So we'll discuss the exclusions now. We'll discuss the exclusions. First exclusion has been abnormal loss in case of material, labor, overhead. So whether variable or fixed, any form of abnormal loss is to be excluded. Administration cost is to be excluded. Selling and distribution cost is to be excluded. There is one more cost that is to be excluded, which is the storage cost. We call it as a storage cost. Unless necessary for production. Now try to understand, my friend. Suppose we sell dairy products. We are a company who sell dairy products. So what we do is we collect all the dairy, milk, butter, ghee, whatever that we are manufacturing, everything we collect it. Now it cannot be sold immediately as soon as it is collected. So we need to store it. We need to store it. Storage is generally cold storage that we use. So cold storage has a very huge cost of storage that is being incurred. The rental cost of storage is very huge. Warehousing cost is very huge. So can this be part as a cost of inventory? Now suppose the storage cost that we are paying is 1 lakh rupees and we have 1 lakh units that can be stored. This is 1 lakh per month. So in the January, the product was manufactured and it was ready. It took 30 rupees for the product to get ready and we have stored it into our storage. First month ends, we were not able to sell the product. So suppose that if we are including it, suppose that we are including the storage cost 1 lakh divided by 1 lakh units, 1 rupee will be included every month. So 1 rupee will be added, this will be 31. In the Feb month, the inventory will be shown in the cost at 31. Again in Feb, suppose we are not able to sell it, 1 rupee more is added, 32. So March, the inventory is seen at a price of 32. Again we were not able to sell it, 33. So we are going to continuously add this 1111 rupee, and at the end, suppose the storage life is also expired of the dairy product, we are going to throw the product, and the inventory valuation we were increasing every year by 1 rupee. So inventory is shown in the credit side of P&L. You are showing an extra income every year. Try to understand, my friend. This is not a correct practice for inventory valuation. That's why storage cost is not included unless it is necessary for the manufacturing of final product. Already final product was the dairy product which we have stored it into the cold storage. So it is already a final product. Such type of storage cost cannot be included in the cost of inventory. But as we talked about wine manufacturing, wine. Now suppose you are going to sell 2-year-old wine. So 2 years we will have to store it. 2 years you will have to store it. So 2 years that you are going to store it somewhere and you are going to pay, let's say, rupees 1 lakh per unit, 1 lakh per month as the storage cost, and 1 lakh liters of wine can be stored in such place. So 1 rupee per month will be allocated till the product gets ready for its final sale. Such storage cost can be included because it is being incurred on WIP. Any cost incurred on WIP can be included, but any cost in the finished goods cannot be included, and any such storage cost on raw material cannot be included. Sir, raw material? Why not raw material? See, I have purchased 1 lakh tons of steel. Let's say I have purchased 1 lakh tons of steel in advance, which is going to be my 1 year's consumption. Complete steel has been purchased in advance, which is going to be my 1 year's consumption for manufacturing of, let's say, car. Every month I am going to consume 10,000 tons. So the remaining steel will be kept in the warehouse, and warehouse will incur some storage cost. So if I keep adding it to the steel, was such quantity, was such inventory that is being maintained by us necessary, compulsory for the final production to be maintained? It was not compulsory. It was not required to be stored in warehouse. We could have bought it when needed. I hope you are understanding the concept. Company generally keeps the inventory of raw material so that it doesn't get stock out. So it is just a planning difference that is being happened. So raw material storage cost cannot be included, finished goods storage cost cannot be included, but WIP, because it takes that much time to store, it is compulsory for the product to be manufactured at that level, such storage cost can be included and form part of the inventory cost. So I hope exclusions are clear till this point. So we'll look at the notes. What do you mean by net realizable value? We haven't discussed this part till now. How do you measure the inventory? You measure the inventory at lower of cost or NRV. Cost includes purchase price, conversion cost and other costs for bringing it to the present location. Cost of purchase includes purchase price including duties and taxes. This is the part we haven't discussed. Suppose the duties and taxes are recoverable. Now we have GST. GST is included in the cost of the inventory. But suppose you cannot take the credit of such GST. Credit of such GST. So GST will be included in the cost of inventory. But suppose you can take the credit of such GST. These are recoverable taxes. Then we will not include it in the cost of inventory. It has to be shown separately. Freight inwards, carriage inwards, transit and directly attributable cost. Cost of conversion, systematic allocation of fixed and variable, production overhead. No other cost shall be included. Like labor cost, store and spares, raw material, repair and maintenance, royalty, supervision, depreciation, but depreciation of, let's say factory, let's say machines, not of office furnitures. Office furniture depreciation cannot be included as a cost of inventory, but definitely machines cost, anything that is used in production, depreciation can be included. Power and fuel. We'll talk about fixed cost. The amount of fixed production overhead allocated to each unit is not increased as a consequence of low production. If you are producing low, you are not going to increase your per unit fixed production overhead. Unallocated overheads are recognized as expense. Something which is not allocated is recognized as expense. But in case of abnormally high production, in some year if the production has been more than the normal capacity, the second example that we have taken, the fixed production overhead per unit decrease so that the inventory is not measured above cost. Inventory should not be measured at above cost. So we'll write it over here that fixed overhead will be divided by normal capacity or actual capacity, whichever is higher. Normal capacity or actual capacity, whichever is higher. Okay. So we have an example. Suppose 1 lakh rupees is the fixed overhead, 10,000 is the normal capacity. That means the amount that is to be allocated is 10 per unit. Now suppose we have only produced 3,000 units and complete 3,000 is in stock. So 30,000 will be allocated to inventory, 70,000 rupees to P&L. 6,000 units were made, 60,000 to inventory, 40,000 to P&L. 12,000 units made, 1 lakh rupees to be allocated to inventory, 0 to be transferred to P&L, no abnormal gain. Actual production has been higher, 1 lakh 12,000 units. What should not be included in inventory? Any abnormal cost. Storage cost, as we have discussed in the production process prior to further production stage, unless they are related to production process. So only WIP. Include. Raw material, finished goods don't include. Okay. Now we have administrative overheads. Unless it is to bring it to the present location, it can be included, else not. And then there is selling and distribution, which cannot be included. So look at some questions. Which of the following forms cost of inventory? Labor cost. Yes, definitely a part of inventory. Depreciation of plant and machinery, as we have discussed, yes, this will be a part of inventory. Salary of payroll director. The director is considered to be administrative in nature, not to be included. Rework cost incurred. Rework is generally considered to be abnormal. When do you rework? When the product has been made defective. When you have made a defective product, we used to rework. So this is considered to be an abnormal cost, not to be included. Sir, what if rework was done as per client specification? Then it can be included, but the question doesn't say so. Normally when we hear about rework, rework is due to improperly made products. Rent of factory can be included, maintenance of machine, again factory overhead can be included. Which of the following expense will form cost of inventory for an automobile showroom? Now you are not a manufacturer, you are a dealer. Remember, you are a dealer. Advertisement expense. We have seen selling and distribution is specifically excluded. Transportation from one showroom to another. This is not from the factory that you are getting the vehicle. It is from your one showroom, you are transferring it to, let's say, another showroom. Such transit cost is not included. Safety material for transport of automobiles, definitely included. Rent of showroom, showroom ka rent, not the factory's rent. This is considered to be administrative in nature, not to be included. I hope it is clear. So we'll move ahead. As a statutory auditor, deal with the following situation. Company deals in purchase and sale of timber and has included notional interest. Notional interest charges calculated on paid up share capital and free reserves. So can this be included? No, it cannot be included. So what are we going to write it over here? In exam we'll write that as per AS2, interest cost cannot be included as a part of inventory. As per AS2, interest cost cannot form part of inventory. As per AS16, now we are discussing it right now because the point has come up, and AS16 was somewhat studied in CA Inter, maybe. Okay, so as per AS16, notional interest cannot be included as a part of inventory. AS16 borrowing cost does not allow you to include notional interest as a part of inventory. Okay, so as per AS2, interest is not included in inventory. As per AS16, notional interest doesn't form part of inventory. Hence, the company's accounting treatment is incorrect. Correct? Company's accounting treatment is incorrect. Okay, so we'll move ahead. So we'll look at the next question. A private limited company manufactures fancy terry towels. A private limited company. A private company limited manufactures fancy terry towels and have valued the inventory of finished goods at realizable value inclusive of profit and export cash incentives. Firm contracts have been received, goods packed, but the ownership is not transferred. Risk is not transferred. So since the risk is not transferred, can you value this inventory as per AS2 including profits? No. Profits cannot be included in the cost of inventory. Export cash incentives, generally if not received, if it's virtually certain that yes, it is going to be received in near future, can be deducted, else not to be deducted. So the answer is there in your notes. We'll move ahead, we'll look at next question. A Limited purchased 1 lakh metric ton, 1 lakh metric ton at 100 each. 1 lakh metric ton at 100 each of raw material and introduced in the production process to get 85,000 metric ton. Normal wastage is 5%. That means normally what you are supposed to get is, if we enter an input of 1 lakh metric ton, we should get 95,000 metric ton, correct? In the process, and incurred following expenses. So there are certain expenses. First expense that was given above was raw material. You have made an input of 1 lakh metric ton which was purchased at 100. The other expenses, labor, overhead and fixed overhead. 10 lakh, 1 lakh. Labor 10 lakh. Variable overhead 1 lakh. And then there is a fixed overhead which is again 1 lakh. But it says including interest of 4625. As per AS2, interest is not included. So what I'll do is I'll eliminate that 40,625. 1 lakh, I'll eliminate the 40,625. What I get is 59,375. Okay. So what should be the cost of inventory? Of the above, 80,000 was sold during the year. 80,000 sold during the year, 5,000 remain in closing stock. Okay, 5,000 units are in closing stock. The next part, due to fall in demand, the market price has been 105. We'll talk about this later. So I'm crossing down the line, calculate the value of closing stock. So let's start. Now see, what you have entered into the input is 1 lakh units. What you should normally get is 95,000 units. But what you actually got is 85,000 units. So there has been an abnormal loss. There has been an abnormal loss, correct? So that means the inventory cost of 1 crore should be divided by 95,000 to get my per unit price for closing stock valuation. Remember, 1 crore will be divided by 95,000 instead of 85,000. So it is 105.26. Labor. Now tell me, for how many units have the labor worked? Have the labor worked for 95,000 units? Or have the labor have the labor worked on 1 lakh unit that was entered as input? Or have the labor worked on only 85,000 unit that turned out to be the output? Most of you will say, sir, 85,000. Tell me, my friend, the raw material that was entered into the machine, did it on its own without any labor got converted into 85,000 units? So some people have worked on it, the machine has worked on it, variable overhead, the labor has worked on it. So all these expenses that were incurred were actually incurred on 1 lakh units, not on the 85,000 units that you got as final production. It was after these expenses that we incurred, we got 85,000 units as production. So there has been an abnormal wastage in labor and variable overhead as well. So in case of labor, again the 10 lakh rupees should be divided by 95,000 units, and variable overhead of 1 lakh should also be divided by 95,000 units. I hope it is clear. So 10.53, 1.05. The last part is factory overhead. Now in the question, normal capacity is not given to you. We don't know what exactly is the normal capacity. Now if we assume that 95,000 is the normal capacity as well, so 59,375 should also be divided by 95,000. 59,375 also to be divided by 95,000, considering it to be the normal capacity, 0.625. So if we add all of them, what we get is 117.46. 117.46. So closing stock as per AS2 will be 117.46 multiplied by how many units do you have in closing stock? 5,000 units. 5,87,300. Sometimes institute asks you how much amount should be expensed off as abnormal loss. Institute does sometimes ask such questions. So it is very simple. 106.46 in multiplied by 95,000 minus 85,000. We consider the 10,000 unit to be the abnormal loss. So 117,460. Okay, so very simple answer that is to be given. Zero zero 1174,600. Okay. Okay, so we need to change this answer. The answer given by ICAI has included material, labor and overhead without any changes being made. Only factory overhead the changes were made. If we consider everything to be abnormal, what we have to do is 1 crore 11 lakh 59,375 shall be divided by 95,000 units. So we get 117.46. Okay. NRV is something that I am not going to cross it. We are going to discuss this later. 105 rupees. So it doesn't matter. Maybe most of you would have understood that since NRV is less than the cost, we are going to value it at NRV. I hope the concept of calculation on the part of removal of abnormal loss, that part is clear. So that's what my concern is right now. So look at the next question. B Limited produces a product at a variable cost of 240 per unit. Variable cost of 240 per unit. Annual production overhead are 25 lakhs. Annual production overhead are 25 lakh, of which 40% is fixed. So now we have a variable cost we know as 240 per unit. We have a fixed overhead which is 25 lakh into 40%. 25 lakhs into 40%. That makes it 10 lakhs. The remaining amount will be variable overheads, 15 lakhs. Okay. Normal capacity is 10 lakh. Company produced 20 lakh units. Company produced 20 lakh units, of which 1 lakh in stock. Of which 1 lakh is in stock. So now if I need to value the closing stock, it is going to be very simple. Variable cost 240. I'll multiply it by 1 lakh units which I have in closing stock, because 240 rupees is completely variable cost, which may be including material, labor, not overheads, other costs, directly attributable cost. Factory overhead 10 lakhs will be divided by normal capacity or actual capacity, whichever is higher. Normal capacity or actual capacity, normal was 10 lakh, actual was 20 lakh, whichever is higher. 20 lakh units. 20 lakh units. So divided by 20 lakh units into 1 lakh units in closing stock. So we have 50,000 rupees allocated as 50,000 rupees allocated as fixed overhead, and we have this 240 lakhs allocated as variable cost. We'll talk about variable overhead. See, the 15 lakh that you have incurred, we call it as variable because variable cost is something that changes on per unit basis, correct? So this is the cost that you may have incurred on 20 lakh units only, I believe, because this is per unit cost. This 15 lakh you would have incurred, company has actually incurred. This is not the notional cost that has been given. Annual production overhead are 25 lakh, of which 40% are fixed. So company has actually incurred 15 lakh rupees on production of actual production, which is 20 lakh unit, because it changes on per unit basis. So this I am not going to check on divided by 10 lakh into 1 lakh. So it will be divided by 20 lakh again. So this is 75,000. So I can say that my closing stock valuation is 241 lakh 25,000 after adding all the three. Be careful with the zeros that you are using and be careful with the concepts that you are using. The concept that we have used for fixed overhead and variable overhead are different as per the costing terminologies. Okay. Next question. In the production process, normal wastage is 5%. Normally we waste 5% of the input. 5,000 units of metric ton were put in the process, resulting in a wastage of 300 metric ton. Resulting in a wastage of 300 metric ton. Cost per unit is rupees 1,000. The entire quantity is in stock in. Now, 1,000 rupees per metric ton is what the cost that we have incurred for 5,000 metric ton of purchase. So that makes it 50 lakhs. Normal production will be 95% of 5,000 because 5% is considered to be the normal loss, 4750. But actual production has been, we have lost 300 units as abnormal, so 4,700. Again it will be whichever is higher, 4,750 or 4,700, whichever is higher. So we'll divide 50 lakhs by 4,750 multiplied by whatever units you have in closing stock. Entire amount is in closing stock. So entire amount 4,700. Remember this, 4,700. The stock that you actually have at year end, 4,700. You don't have the remaining 50 units. They are abnormal loss. So that gives me 49,47,368. I hope it is clear till this point. So we'll move ahead. So look at next question. Anil Pharma Limited ordered 16,000 kgs of material at 160 per unit. Purchase price includes, remember the words that are being used, includes, it can be includes, it can be excludes. Include 10 rupees per kg for which SENVAT credit is admissible. So as we have read, whenever SENVAT credit is admissible, do we include it in the cost of the inventory? We don't include it, na? So what I'll show my inventory is at 150 instead of 160. But what if the word was instead of includes excludes? The purchase price excludes excise duty of 10 for which SENVAT credit is admissible. Then we are not going to include this 10 rupees and neither are we going to deduct it. It will be shown at 160. So remember the words that are being used. So it will be at 150 rupees Freight incurred 140, 160. So let me write down all the expenses. So we have raw material, which is to be valued at 150, and we have purchased 16,000 kgs. Now there is a freight that has been incurred. The freight incurred is 140, 160. So freight is always included, correct? Normal transit loss is 2%. Normal transit loss is 2%. So let me write down normal receipt will be 16,000 multiplied by 98%, 15,680. 15,680. Company actually received 15,500. Again, what we have received is lesser. So there is an abnormal loss again, as we can see, and consumed 13,600. Consumed 13,600. So what I can say is that closing stock left with us is 15,500 minus 13,600, 1,900 kg or units. Calculate the cost of inventory as per AS2 and amount of abnormal loss. So as I told you, sometimes they do ask us to value the abnormal loss as well. So it is going to be very easy. This is our total cost. $24 lakhs plus 140, 160, 25 lakh 40,160. Closing stock will be valued at 25 lakh 40,160 divided by normal receipt. Normal receipt is 15,680 multiplied by what is the closing stock that we have, 1,900 kgs. So I hope it is clear. $307,800. Let's calculate the abnormal loss that we used to calculate in our CA Inter. 25 lakh 40,160 divided by again 15,680. What you were supposed to receive was 15,680 units, but you actually received 15,500. How many units you have received? Less than expected. Less than expected. 160 units, correct? So 160 unit that you haven't received will be considered to be abnormal. What we have not received is abnormal loss. So 25 lakh 40,160 will be divided by again 25,680 multiplied by 160. That gives me 25,920 as my abnormal loss as given in the question. Okay, it is 180 units. 180 units, not 160 units. 29,160. 29,160. So 307,800 and 29,160. The answer is printed in your notes. I hope the concept is clear as to how we are going to value the same. Next question is similar, so we are not going to discuss it right now. Okay, no, there are some more terminologies. Okay, we'll look at the question. Let's see. Z Limited ordered 13,000 kgs of chemical at 90 per kg. Purchase price includes 5 rupee per kg in respect of which full sand VAT credit is admissible. Further, state VAT is leviable. Further state VAT is leviable. Leviable means it is not included at 2.5 per kg in the purchase price. Now they haven't told whether the VAT credit is admissible or not. I mean input VAT is available or not. So either you assume it, assume credit available. So if I assume that credit is available, I will not include this 2.5. Remember, I will not include this 2.5 in my inventory cost, neither am I going to deduct it because it is not includable, it is further leviable. It is further leviable, so not included in the 90 per kg ka price. So 2.5 is not to be included, neither to be deducted, okay, because credit is admissible. Freight incurred 30,000, normal transit loss 4%, company actually received 12,400, consumed 10,000. So I know that the closing stock available with the company is 2,400 kgs. Company has received a trade discount. Remember the word that has been used, trade discount of 1 rupee per kg. 1 rupee per kg definitely to be deducted from the cost of the inventory. So 90 rupees will be deducted by this 1 rupee and definitely excise duty as well. Chemicals are delivered in containers. The containers are not reusable and hence sold for 500. Sold for 500. Generally, such scrap sales, the treatment of scrap sale, we are yet to come ahead with the treatments of byproducts which includes scrap sale as well, is deducted from the cost of the inventory. You can show it as other income, but best is to deduct the cost of inventory by them. Admin expenses incurred in bringing the chemical bring the chemical is 10,000. So bringing the present location, admin cost is included. So 10,000 will be included. So let's see how are we going to value the inventory. First thing is purchase price. Purchase price is 90. I have to deduct trade discount 1 rupee and it includes excise duty of 5 rupees. This is also to be deducted. So 84 rupees for 13,000 units. Okay. $10,92,000. Now we are going to include transportation cost in it, which is given to you as 30,000. VAT will not be included, neither be deducted as discussed earlier. We are going to include admin cost 10,000. Okay. Containers is something that we are going to reduce. Sale of containers we are going to deduct from the cost 500. So what we have now is 30,000 plus 10,000 minus 500, 1131 500. Okay, 1131 500. What is the normal production that you are supposed to get? What is the normal production that you are supposed to get? It tells us that 4% transit loss is something that normally happens. So 13,000 multiplied by 96%, 12,480. Actual, it should not be production, receipt. Actual receipt has been 12,400. So we can see that there is a loss, abnormal loss of 80 units. Abnormal loss of 80 units. What is the closing stock that we have? 2,400. 12,400 is actual production and 10,000 consumed. So the value of closing stock will be 1131 500 divided by 12,480. Normally what should have been produced, multiplied by 2,400 units, that is left with the company. So it will be valued at 217,596. Okay, there can be multiple assumptions like SENVAT credit is not available, input credit is not available for VAT. You are going to include the VAT. Containers, if you are show it as other income, it shall not be included over here. So valuation has been done without deducting the cost of containers over here. You are going to see the same question again after few pages in which we have deducted the cost of containers. So we'll move ahead. Next one, Nidhi Limited purchased raw material at a basic price of 10,000. Basic price of 10,000 on which, not in which, it doesn't includes, over and above, excise duty of 1,500 is paid. Cost of inventory at the stage would be 11,500. The material is thereafter processed. For this, conversion cost of 1,800 was incurred. Excise duty liability amounting to 1,700 is being paid by the company. Now this excise duty question, I believe we should not discuss it now because excise duty was on production and GST is on sale. So it makes a difference. We are not going to discuss this question right now. Just simply cut the question. Okay. Question number 18 talks about NRV valuation. We are yet to discuss what NRV is all about. So we will discuss this later. Let's look at the 19th question. Closing stock of XYZ Limited amounts to 9,57,000. Okay, it is again the same question. Okay, now we are going to see the same question. So we have to start with the concept of NRV. Definitely you are looking for a break, so we'll take a break at this point and then we'll continue with the discussion on NRV and see the remaining questions on how to value the same. Okay.